Silver just went through one of the most violent corrections we've seen in a long time, just wiping out billions in value. And the question on everyone's mind is pretty simple. Is this a healthy pullback in a roaring bull market, or are we watching the whole thing just collapse? Let's unpack what really just happened.
So to really get what happened, you got to rewind the clock just a little bit. It was only 52 days ago, January 29th, that silver hit an all-time high of $121 an ounce. I mean, the market was absolutely euphoric. The hype was just deafening.
And then, bam! Fast forward to today, and we're hovering around $72 an ounce. The drop from that peak was just brutal and fast, and it's caused a ton of confusion and, frankly, a lot of panic in the market.
So let's be super clear here. A 41% drop in less than 2 months, that is not a minor dip. A move this violent, it really demands an explanation. Was it a complete breakdown in the fundamentals, or was there something else going on? Let's get into the mechanics.
You know, the best way I've found to wrap my head around this price action is with a pretty simple analogy: the splash versus the water. These are the two competing stories, but they're also connected, and they really define everything that's happening in silver right now.
And this slide right here, it just lays it all out perfectly. It separates the noise from the reality. On one side, you've got the splash. That's the wild, temporary price spike. It's caused by leveraged traders, FOMO, all that stuff. And on the other side, you have the water. That's the real underlying value based on actual physical supply and demand. The recent crash, that was all splash.
And look, don't just take my word for it. The Bank for International Settlements, we're talking about the central bank for all the central banks, they came to the exact same conclusion. They called the January price spike, and I quote, a classic boom-bust driven by speculative excess. So the problem wasn't a flawed fundamental story. It was just way too much leverage.
Okay, so let's really dig into this swimming pool analogy. The water in the pool, that represents the true fundamental value. And this is driven by rock-solid factors. We're talking a 6-year supply deficit, massive industrial demand, and China's huge move to ban exports. This water level, it's real, and it has been rising steadily for years.
The splash is what we saw back in January. Imagine a huge crowd of speculators all just cannonballing into the pool at the exact same time. It created this massive, violent splash that made it look like the water level was at $121. But it was just a temporary illusion. The water itself hadn't actually risen that high.
What's wild is that this isn't just random chaos. There's actually a pretty predictable cycle for how this speculative froth gets washed out of a market. You get a great story that attracts hype, the price goes way too high, some trigger forces all the leverage out, and then the price collapses. The really crucial thing to see here is that we are likely right there in step 5, stabilization, where the real fundamental buyers start stepping back in.
Okay, so enough with the analogies for a second. How does this all translate to what's happening on the charts right now? Well, with all that speculative froth washed out, pro traders are now focused on 3 critical price levels that could act as major floors of support. All right, so there are really 3 numbers that matter most right now. $70 is what some are calling a wall of buyers because it's held strong 3 times already. $60 is that big one, the 200-day moving average, kind of the major line in the sand for the bull trend. And then you've got $50, which is the ultimate floor, the zone where this entire rally really launched from.
But out of all of those, that $60 level, man, that is the big one. It's not just another number on a chart. For professional traders and all the trading algorithms, a sustained break below the 200-day moving average, which is right around $60, that is the official line that separates a bull market correction from the start of a bear market. It is that critical.
But here's the thing. While all the paper traders are freaking out over charts and technical levels, it is so important to zoom out and look at the physical world. Because the whole bear case for silver right now, it completely ignores the powerful, unchanging reality of industrial demand.
Right now, the market's basically split into 2 extreme camps, and honestly, they're both getting it half right and half wrong. You've got the perma-bulls who say it's all manipulation. They're right about the fundamentals, but they totally miss the danger of that speculative bubble. Then you have the bears. They were right about the bubble popping, but they are completely ignoring how permanent the physical demand for silver is. The truth, as it usually is somewhere right in the middle.
And this is what's so crucial to remember. Let's talk about everything that has not changed one bit during this 41% paper price collapse. China still considers silver a strategic material and has banned exports.
The market is still in its 6th straight year of a supply deficit. The demand from solar and EVs is non-negotiable. And huge companies like Samsung and Tesla are literally bypassing the exchanges to go secure their physical supply directly.
And look at these numbers. This isn't about some investor deciding to buy a coin. This is about consumption. This demand is what we call inelastic, which is just a fancy way of saying factories have to buy the silver to operate whether the price is high or low. Solar panels, EVs, electronics, they will consume hundreds of millions of ounces this year, and that demand is not going anywhere.
Okay, so that's a lot of information. The big question is, what do you do with it? Let's get really practical here, because there are two groups of people watching this, and the right plan of action is completely different for each one. So this boils down to two distinct plans. First, if you're sitting on cash, your greatest asset right now is patience. This whole speculative unwind might not be over, which means a better entry price could be ahead. Now, if you're in the second group and you already bought high, the key is to not sell into a panic. Reassess your original thesis. If the fundamentals still hold up for you, then the most important signal to watch is whether silver can hold that $70 level on a weekly closing basis.
You know, at the end of the day, after all the charts and all the speculation, I want to bring it back to the single most important number in this whole story. 800 million ounces. That is the cumulative physical deficit over the last 6 years. That's metal that has been consumed and is gone forever. This is the water in the pool. It's the anchor of reality in a sea of speculative noise.
And that really is the question this all boils down to. After a 41% price plunge, it's so easy to get caught up in the fear and the scary headlines. But the real question you have to ask yourself is this: is the temporary noise of the splash drowning out the permanent reality of the water?